While everyone spent the last 3 months staring at a red candle, the largest payment company on the planet quietly announced something that should have stopped every XRP holder cold. Brad Garlinghouse sat down on Fox Business and said it plainly. Ripple Treasury processes $13 trillion in annual corporate payments, and 0%, has touched crypto rails yet. Not because the technology isn't ready, not because the demand isn't there, because one piece of legislation hasn't crossed the finish line. That legislation is 4 weeks from a vote. I need you to understand exactly what that number means, and exactly what happens the moment that vote passes, because the mainstream financial press is not connecting these dots for you. They're covering the price. I'm covering the mechanism. Let's get into it. Welcome back to Ledger.Wealth.Network. I am the analyst. Around here, we run the math that most channels skip: the supply side, the institutional positioning, the legislative mechanics, so you can make an informed decision with the full picture in front of you, not financial advice. Always do your own research. Now let's pull back the curtain. Let me give you the hard truth that most XRP commentary is completely missing right now. The question everyone is asking is, why is XRP at $1.30 when Ripple just reported the best quarter in the company's history? That question reveals a misunderstanding of what we're actually watching. And if you don't correct that misunderstanding, you will misread every signal coming out of this ecosystem for the next 90 days. Here is the reality. Ripple the company and XRP the asset are not the same thing yet. Right now, in April 2026, Deutsche Bank, Aviva Investors, and Societe Generale are running on Ripple's payment infrastructure. Fortune 500 treasury teams are processing corporate settlements through Ripple's systems. Prime brokerage revenue tripled following the Hidden Road acquisition, and the institutional pipeline is described by Garlinghouse himself as the biggest untapped opportunity in global finance. But here is what those institutions are settling in: RLUSD and fiat, not XRP. That is not a betrayal of the thesis. That is a compliance decision. And it is the most important distinction in this entire ecosystem right now. Think about how a major bank operates. Before they put a volatile digital asset on their settlement rails, an asset that moves 10, 20, 30% in a week, their legal team, their compliance department, their board, and their regulators all have to sign off. Without statutory clarity, without a codified federal classification that says this asset is a commodity, not a security, and you are legally permitted to use it for settlement, the answer from every bank's legal team is the same: use RLUSD. That is the only reason XRP is sitting at $1.30 while Ripple posts record quarters. It is not adoption failure. It is a legal holding pattern. And the Clarity Act is the release valve. On March 17, 2026, the SEC and the CFTC jointly issued a binding federal rule classifying XRP as a digital commodity alongside Bitcoin and Ethereum. Not a court ruling, not staff guidance. A codified regulatory classification with the full weight of federal law behind it. The legal cloud is gone. The settlement cleared at a fraction of what the SEC originally demanded, $125 million against a $2 billion ask. What the Clarity Act does is the next layer. It doesn't just confirm classification. It creates the statutory framework that allows U.S. banks, the most compliance-driven institutions in the world, to use XRP as a settlement bridge without violating their fiduciary obligations. That is a specific legal mechanism, and without it, every bank defaults to the safer choice. With it, the choice between RLUSD and XRP becomes a cost and efficiency question. And on cost and efficiency, XRP doesn't compete. XRP wins. 3 to 5 second finality. Fractions of a cent per transaction. No pre-funded Nostro accounts. No idle capital sitting in 17 correspondent banking nodes waiting to be used. You now understand why the Clarity Act is not a talking point. It is the switch. Now let me show you the math, because numbers without a framework are just noise. And this particular framework is what changes the entire picture. Ripple Treasury processes $13 trillion in annual corporate payment volume. That number is not a projection. It is the current operational figure that Garlinghouse cited explicitly on Fox Business. And 0% of it is running on XRP. Here is the supply side of that equation. XRP has a fixed total supply of 100 billion tokens. Circulating supply sits at approximately 55 to 57 billion. Exchange reserves have been declining. Data from CryptoQuant shows consistent outflows from major exchange wallets, meaning tokens are moving off markets into custody. That is a structural supply contraction. Now apply the liquidity math. The global cross-border payment market moves approximately $150 trillion annually. Banks globally hold an estimated $1.8 trillion in pre-funded Nostro accounts. Capital that sits idle, earns nothing, and exists purely to grease the wheels of correspondent banking. XRP eliminates that requirement entirely. Convert, send, convert. 3 seconds, done. If XRP captures just 2% of the annual Nostro liquidity requirement, 2% of the capital rotation through those $1.8 trillion in accounts, you are talking about $36 billion flowing through XRP rails annually. That is not the full cross-border payment thesis. That is the conservative single-use case floor scenario. And here is where the math becomes structural rather than speculative. To move large value corporate payments through XRP rails without catastrophic slippage, the price of XRP has to be high enough that the required token volume doesn't exceed available liquidity. In other words, the system itself creates a demand floor based on throughput requirements. Standard Chartered ran this model and published a roadmap. 280 base case by end of 2026, $7 by 2027, 1260 by 2028, 1960 by 2029, $28 by 2030. Their 2030 figure has held unchanged through the entire 2026 correction. That is not a momentum call. That is a liquidity requirement model applied to projected throughput. The bear case without the Clarity Act is 280. The bull case with it is $8 near term and $28 by 2030. One bill, one vote. That is the entire spread between those two scenarios. Let me show you what the institutions are actually doing right now, because retail is watching the price and institutions are watching the architecture. 7 spot XRP ETFs launched in the United States in November 2025. Goldman Sachs disclosed a $153.8 million XRP ETF position within weeks of launch. The largest institutional XRP ETF holder in the market, not a crypto native fund, not a venture firm. Goldman Sachs. That position went in at prices above where XRP sits today. Ask yourself the question that actually matters. Does an institution with Goldman's legal exposure, Goldman's compliance infrastructure, and Goldman's fiduciary obligations to its clients make a $153.8 million bet on a speculative token without absolute conviction about the legal and regulatory outcome? Absolutely not. They don't gamble. They position. Now look at the surrounding infrastructure being assembled simultaneously. SWIFT, the network that connects 11,000 banks globally, is targeting a live launch with 25 or more XRP payment corridors by mid-2026. The DTCC, which clears and settles the backbone of U.S. equity markets, has Ripple Prime in its vendor directory. NASDAQ is targeting Q3 for tokenized stock rollout. Securitize is building tokenized securities markets with the NYSE. BlackRock is using RLUSD as a settlement layer in its tokenization stack. These are not announcements about what might happen. These are live integrations from the most risk-averse, compliance-driven institutions on the planet. And they are all converging in the same 90-day window. Meanwhile, the retail signal in this market is a fear and greed index sitting at 8. Extreme fear. The crowd is looking at a chart that shows XRP down 40% year to date and drawing conclusions about a fundamentally deteriorating asset. What they are not looking at is that XRP is down 40% while Goldman Sachs is in, while 7 ETFs are live, while the commodity classification is codified federal law, while SWIFT is wiring the protocol into 11,000 banks. And while the Clarity Act is 4 weeks from a Senate vote with a 90% passage estimate from the man running the company that built this system. Retail sees the price. Institutions see the position. That gap between what the chart shows and what the infrastructure reveals is exactly where asymmetric setups are born. Let me give you the specific window, because timing matters here and the window is narrow. is the Senate returns from recess on April 13th. The Banking Committee markup is targeting the second half of April. Garlinghouse is public with a 90% passage estimate. Polymarket, which prices real-world outcomes with real money, is at 72%. Galaxy Digital's internal analysis puts the hard deadline as committee clearance by end of April, or the bill is likely dead for 2026. Senator Moreno confirmed the midterm election cycle begins closing the legislative window in May. That means the actionable window for the Clarity Act in this Congress is approximately 3 to 4 weeks wide. Everything that XRP has built toward for 4 years, the legal battles, the ETF launches, the institutional partnerships, the commodity reclassification, it all runs through what happens in that window. Then, in May, Goldman Sachs files their Q1 2026 13F. That filing will reveal whether the largest institutional XRP ETF holder maintained their $153.8 million position through the 43% decline or trimmed. If they held, every institution sitting on the fence gets the signal that the smart money stayed through the fear. If they added, the signal is even louder. After that, Swift corridors live by mid-year. DTCC tokenization pilot progressing. NASDAQ tokenized equities in Q3. The catalysts are not theoretical, they are scheduled. Here is the position reality that most people in this space never calculate. The XRP Ledger has 7.85 million activated wallet addresses. Estimated unique global holders sit between 18 and 25 million people. Of those 25 million holders, only the top 10% hold 2,300 XRP or more. The median XRP wallet holds between 50 and 100 tokens. Most people who own XRP own very little of it, which means the structure is already in place. The scarcity of meaningful positions large enough to matter at institutional price targets, already exists. And it exists at a price that is accessible today in a way it will not be at $5, $10, or $28. Nobody rang a bell at 17 cents in 2020. Nobody rang a bell at 30 cents in 2023. They won't ring one now either. The people who will be at every price level above here are the ones building their position before the legislative switch flips. I will give you the honest bear case because you deserve the complete picture. Adam Spitaco at NASDAQ argues that XRP could fall to 50 cents to $1 by 2030. His thesis: banks settle permanently in RLUSD and fiat. The token becomes irrelevant to Ripple's success, and the institutional wave never materializes. That bear case requires 3 simultaneous negative outcomes. The Clarity Act fails, stablecoins permanently replace XRP's bridge function, and Goldman and 6 other ETF issuers are wrong about institutional demand. Possible, not probable, given the evidence currently visible on-chain and in the regulatory pipeline. The math on the downside is a 63% loss on a position most people can fund in under a month. The math on the upside, at Standard Chartered's 2030 target, is a 20 times return. That asymmetry doesn't require certainty. It requires conviction in the probability distribution. Let me leave you with the one statement Garlinghouse made that I want you to sit with. Ripple Treasury processes $13 trillion in annual corporate payments. 0% has migrated to crypto rails. He called it the biggest untapped opportunity in global finance. And he said the Clarity Act is the unlock. That is not a roadmap for what might happen. That is a loaded spring waiting for one legislative release. The infrastructure is built. The legal classification is codified. The institutional capital is positioned. The payment corridors are being wired into 11,000 banks. The only question is whether you understand what you're looking at before April ends. Run the numbers, check the on-chain data, read the Standard Chartered research, and make a decision with the full picture, not just the red candles. In a market fueled by emotion and noise, we thrive on data and composure. Haste leads to loss. Calm analysis leads to victory. I am Ledger.Wealth.Network. Stay patient, stay rational. And as we always do, we don't wait for the future. We plan for it. Peace.